The S&P 500 is up around 8% this year. Everyone is celebrating that. But there is another index sitting at plus 17%, more than double the broader market, and almost no one is talking about it. The Russell 2000 has been one of the best performing indexes of 2026, and if your portfolio is still built around mega cap tech and AI names, you may be missing the most interesting trade of the year. Let me show you exactly what is happening here. Start with the raw numbers. The S&P 500 is up approximately 8.3% year-to-date as of this week. That is a solid performance by any measure. But the Russell 2000, the index that tracks smaller American companies, is up 17.37%. That is not a small gap. That is a completely different investing experience. And here is where it gets more interesting. The PHLX Semiconductor Index, which tracks chip stocks, is up over 81% this year. So you have three different worlds performing inside the same stock market. Chips at the top, small caps in the middle, large cap S&P 500 lagging both. Now most investors have heard about the semiconductor surge, Nvidia, TSMC, memory chips. That story has been everywhere. But small caps sitting at 17% while the S&P 500 sits at 8%, that is the story fewer people have actually sat down to understand. So what is actually driving small cap outperformance? There are a few things working together here. The first is market breadth. For most of 2024 and early 2025, the stock market rally was extremely narrow. 7 or 8 mega cap tech companies were doing most of the heavy lifting. If you did not hold those names, you barely participated in the rally. But in 2026, that dynamic has started to shift. Leadership is broadening, financials are gaining, healthcare is moving, defensive sectors are picking up ground, small caps are catching a bid. This is what analysts call a healthy bull market. Not one name dragging the index higher, multiple sectors sharing the weight. Now here is the second driver, and this one is tied to real economic conditions. Oil prices fell sharply this week. WTI crude dropped more than 5% in a single session. That brings prices closer to $80 a barrel. For small cap companies, that matters enormously. Smaller businesses tend to have thinner profit margins than large corporations. They are more exposed to energy and transportation costs. When oil comes down, their cost base shrinks. Margins improve faster. Earnings can surprise to the upside. The potential reopening of the Strait of Hormuz following ceasefire hopes is also putting downward pressure on oil prices. If that holds, small caps could see continued margin relief throughout the summer. There is a third factor that does not get discussed enough: interest rates. The 10-year Treasury yield fell to 4.45% this week. That is still elevated by historical standards, but the direction matters as much as the level. Small companies rely more heavily on borrowing than large corporations. When rates climb, their debt costs rise faster. When rates ease even slightly, the benefit hits their bottom line quickly. The Fed has kept rates on hold, but markets are beginning to sense that the next major move could be downward. That expectation alone is creating room for small caps to breathe. If you enjoy breaking down markets and money, subscribe for future updates. Now let us talk about what the equal weight S&P 500 is telling us, because this is a detail worth paying attention to. The cap-weighted S&P 500 gives most of its influence to the biggest companies. Apple, Microsoft, Nvidia, they shape the index's daily moves more than smaller members. The equal weight S&P 500 gives every company an identical slice of influence. This year, the equal weight version is outperforming the cap weight version. 11% versus 9% year-to-date. That is a meaningful signal. It means the rally is no longer being carried by a handful of giants. Hundreds of companies across the index are contributing to gains. That kind of broad participation historically signals a durable bull market, not a fragile one held up by just a few pillars. Let us bring this down to what it means for you personally. If you own a total market index fund, some small cap exposure is already built in. The Vanguard Total Stock Market ETF, for example, holds thousands of companies, but most of its weighting still sits in large caps. You get some small cap participation, but not a significant allocation. If your portfolio is built primarily around S&P 500 funds, your small cap exposure is even lower. The S&P 500 only holds large companies by definition. Small caps are entirely absent from it. So, if the Russell 2000 runs another 10%, while the S&P 500 adds 4%, you would barely feel it. Now, this is not a call to abandon your core strategy. Index funds built around the S&P 500 remain one of the most powerful long-term wealth-building tools available. but understanding where the market's momentum is sitting right now is genuinely useful. For investors with longer time horizons, a dedicated small cap allocation has historically provided additional return over decades. The academic research on this is deep. It is called the size premium. Smaller companies, on average over long periods, have outperformed their larger counterparts. The reason is simple: smaller companies carry more risk, and the market tends to reward extra risk with extra return over time. But here's the practical reality: that outperformance is lumpy. Small caps can underperform for years, then surge in a concentrated window. The people who benefit most are the ones who held the allocation before the surge happened, not the ones who piled in after reading about it. This week's data shows the Russell 2000 is already up 17% in 2026. Some of the easy money may have already moved, but the conditions supporting this rally, easing oil prices, broadening earnings, a potential rate pivot ahead, have not fully resolved. The runway could still be meaningful. One more thing worth acknowledging: this is not a risk-free environment. The May CPI print came in at 4.2% year over year. That is the highest inflation reading since early 2023. The Fed is not cutting rates yet. Geopolitical uncertainty around the Strait of Hormuz has not been permanently resolved. A ceasefire is not the same as a peace deal. Small caps are more sensitive to domestic economic conditions. If inflation reaccelerates or recession fears return, smaller companies tend to feel it first. So what is the balanced way to think about this? The data right now is constructive for small caps. The macro backdrop is supportive but not guaranteed. For investors already holding a diversified portfolio, understanding that small caps are leading in 2026 is worth factoring into your next review, not as a reason to make dramatic changes, but as a reason to make sure you are not leaving a meaningful part of this rally completely untouched. The market is telling a different story than the one in the headlines. The people who read that story carefully tend to build wealth more consistently over time. That is what the numbers are showing right now. What you do with that information is up to you.